I just forgot to ask this question. I'm so sorry. I had one more question in relative with efficient price action, meaning assuming ICT, assuming price goes up and reaches a specific zone where price action is efficient at that zone and creates a high, and then again comes down and reaches another efficient price action and creates a low, and then price comes in the middle. How do we know, firstly, which one of those new created high or low is going to be attacked first?
You don't. What you described is a consolidating market. So you're going to let them wrestle that without your participation. Just let the market break out of there. You're not trying to trade the breakout, but you want to see what it does and what side it takes out first. And if you remember, if you've gotten this far in the content, when I started teaching the early session, 7 o'clock to 9 o'clock in the morning Eastern time, New York local time, I said, look at the smooth highs and the lows. Okay. And you want to see if it's smooth on both sides, you want to see which one they're going to take first. And usually they take the side that is a false breakout and then they'll run for the other side. So it gives you an opportunity to trade in a way where let the let the first mouse try to get the cheese, get caught in the trap, and then you run over there when there isn't any trap danger and you can get the cheese. Well, what you're describing at the time you're describing it, I would not participate in that. And I don't have any way of knowing from a generic description like you have. I wouldn't have any strong convictions on being able to determine what side it's going to break out or run from. So I just simply let it do it. And then once it does that, is it able to hold on to that? And if it doesn't, and it breaks back down into the range, then I'll use a fair value gap or an inversion fair value gap to participate and look for the other side to be traded to. So you're going to have to wait for the first one to be given to you like a gift and then run to the other side.
So, sir, generally, you mean we have to first wait to see one of those sides to be taken. Then we have to look for reversal sign if price want to reverse. Exact, and we may enter maybe in a inversion fair value or fair value cap, right?
Well, that's one scenario. Yeah, I mean, there's other things that could be done, but I'm trying to be simplified with what you give me as a criteria or context. Plainly said and simply stated, if you're in a position where the market's in the middle of two balanced price ranges, because that's what you're describing, you're
Yes, sir.
sandwiched in, okay? And I don't have the ability to determine when it enters there with any measurable, you know, consistency that I would be able to try to convince you of. I simply wait and let it give me one side. Once it does that, then I'll look at price action. If it goes there at a specific time, I'll give you an example. You mentioned it went up into a balanced price range. If
Yes,
it
sir.
does that, and then it retraces back down, and it's resting on a balanced price range where it's consolidated a big block of price action. It couldn't break through on the upside, and then it retraced back down, but it can't break through to the bottom part either. So if it runs up and takes out the upper side, so it's clearing out the buy side above that consolidation that it couldn't make its way through the first time, but it does so at a time like 50 minutes after the hour. So we're inside of a macro time, inside that little 20-minute window period. If it does that, I'm more inclined to anticipate that as a setup to see it run for the lower side. And then I would look for a short. Now, if it does it on the buy side, no, I'm sorry, if it does it for the sell side, rather, it goes down below the lower consolidation and it does it during a macro time. I would view that as a setup to set me up for a bullish inversion fair value gap or a bullish fair value gap to trade into or model 2022 long to set me up for a run up to clear out the highs above the higher consolidation and take out that buy side. But I have to see what they're going to give me first and base that on what time are they doing it.
Thank you so much, sir. Thank you so
You're
much.
very
That
welcome.
was so helpful. Thank you so much.
In adding in conclusion, what Michael is telling all of us, ladies and gentlemen, and I can speak on very personal experience, as much as you have opportunities to engage, you're identifying the moments when you don't want to engage. Having criterion to disengage is equally as important as having any form of entry criterion or model. So this is kind of like the yin to the yang, kind of like the gap to the range, right? Kind of like the positive to the negative. You want to know when you are in, and you definitely want to know when you are out. Constantly describing market conditions that are indecisive, that are within a range, I playfully call a no flying zone. And we try to identify these range prices that we don't want anything to do with it. Let it decide what it wants to do. So anyway, on that note, thank you, Michael,
Can
for
I add
being
something,
here.
a little thing
Oh,
about
pretty
yes,
please, Pit
really,
Much.
really small, because I think, if I'm correct, I think it resonates with this. And I have some tweets saved from Michael from over the years. And what he said in those tweets is it's basically the same every time. And it's when you are able to frame both sides, then it simply means it's a low probability ICT trade. So you don't do that, and you wait until the market gives you clarity, like he's saying right now. You wait for one side to be taken out, and when that happens, then you look at, okay, what does it look like now? What do we have here? And then you work from there. And as long as you don't have that, it's just like you can frame both sides, so it's just low probability. So it's simple.
Very well said.